Today's presentation is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy Excel, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented at the workshop should only be used by investors who are aware of the risk inherent in trading. Equus shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. So now that the lawyers are happy, I get to introduce somebody I actually met at the LA Traders Expo last year. And as you know, I like to bring in a lot of different people to do a lot of different talks on different methodologies. Scott's somebody that actually stood out to me as somebody that was very, very specialized in gap trading, and he showed me a lot of the research he had done there. And it was something that I'm very, very excited to actually see his presentation today. He's been trading in the markets, as you've seen, for quite a few years, and has a service to help people identify and profit from gap plays. And so we're really excited to welcome him. It's his very first MetaStock presentation tonight. And Scott, we're going to go ahead and turn the time over to you. Are you here? Go ahead and get going.
All right. Thank you, Jeff. Well, welcome everyone. As Jeff said, my name is Scott Andrews, and I trade the opening gap. Just a little bit before I get started, give you a little bit of context. I noticed we did a survey, Jeff did a survey when we were a few minutes ago, and quite a few of you are not currently trading the gap. So I think you'll find this presentation informative. But a little bit of background in terms of how I ultimately ended up trading the gap. In fact, I trade primarily the opening gap. It's really truly my bread and butter. I am highly specialized on just the opening gap. I dabble with a few day trades other than the gap, but the bulk of my capital and my focus is all focused on opening gaps. But I started out swing trading, holding trades for multiple days, weeks, even months at a time, using mostly options. I spent a lot of money with an mentoree who was well established, well known, and credible. I did a lot of homework, and ultimately, after about a year with him, I learned that he was a world-class trader and that I was not. It just was a terrible fit for me in terms of his style, and I couldn't quite figure out what was going on. I finally backed up and said, what's going on here? And I realized that I was not good at holding on to positions without tinkering with them, so I was constantly messing with my trades, cutting my winners short, holding on to my losers, and when I try to analyze why I was doing that, it ultimately came to the conclusion that it was because I did not have any mathematics in my decision making. I'm mathematically oriented. I'm not a math whiz or anything. I understand numbers and statistics, and I never knew what the optimal target was or the optimal stop, where to get out of a trade. So I had to fall back on my gut feeling, if you will, using discretion, and quite frankly, that was a disaster. So it led me to focus ultimately on the opening gap, but treat it as a swing trade. So I don't know if many of you are swing traders or day traders, or how you think of yourself. You may just be an active investor, but essentially what I do is focus the bulk of my liquid capital, if you will, of my trading accounts on the opening gap. So essentially, like what a swing trader would do, building a big position, holding on to it for a long time, I do the same thing with the opening gap, except where I am in and out the exact same day. I never hold trades overnight. So I think of myself sort of as an aggressive swing trader, and the key to my success has been an enormous amount of work I've done analyzing opening gaps and determining their probability of filling. So I'm going to show you how I trade the gap this evening, and hope to answer any and all of your questions that I can. I do have a gentleman that is our trading coach at Master the Gap. His name is Tim Mock, and assuming he doesn't fall asleep on me, he will help me answer questions. So if you ask a question and I don't get to it immediately and he can answer it in text response, Tim will answer it the best he can. I encourage questions as we go along. If you can keep them sort of focused on the slide that I'm on, that will help. If you ask a question and I don't answer it right away, you may have to repost it later in the webinar. But we should finish up in about 50 minutes or so, depending upon your questions, and I'm happy to go a few minutes longer if that would be helpful. Okay, so without further ado, everything Jeff said applies to me as well. So use this information at your own risk. I will say this, all the information I'm going to show you, I personally conducted the research. That's my style, and I believe it to be true and accurate, and it's information that I use, okay? So I'm going to take you through the basics of gaps. I want to make sure you understand what I mean by an opening gap, because there are several different ways to define gaps. I'm going to take you through how I trade gaps. I want to be clear, this is what's worked for me, and it's actually worked for hundreds of other people around the world that trade gaps in a similar manner. But it doesn't. I'm not here to tell you this is the way you need to trade gaps. One of the keys to success trading is, of course, adopting a style or developing a style that fits you and your personality and your account objectives and so on. So I'm just going to take you through how I trade gaps, and hopefully you'll get some nuggets and ideas on if you're interested in that may apply in you trading gaps on your own. The foundation of everything I do is based upon zones, opening zones. I'll spend a great amount of time on that. I'll take you through some nuggets on entries and targets and stops that are backed by research, and then show you how to get some more information if you are interested. I'm not a hard sell kind of person. I'm not here to sell you on master the gap. I think of myself as a gap trader first and foremost. We do have a great little business on the side with the help of Tim and another gentleman, Chris. We love helping people, and we think the key in what we do is really the research that we provide. So a little bit different than a lot of other educators out there. So that's all I need to say about that. Next slide. So this is how I define gaps. When I'm talking about a gap this evening, simply the difference between a security, whether it be a stock or an index or a commodity, some asset class, difference between its opening price and its prior day or session closing price. Right? Many commodities, many futures markets trade essentially 24 hours a day. I ignore that action because much of the volume is not transacted in the overnight session for these markets, but rather during their regular trading hours. That's a term that represents generally 9:30 Eastern time here in the U.S. until 4:15 Eastern time in the U.S. And that's when the Chicago pits are open for the index futures. And index futures are primarily what I trade. Anyhow, this difference shows up on a price chart as an open space or gap. Here's a picture of one. This is when you're supposed to chuckle. But I can't hear you, so I'll just assume you are chuckling right now. Our friend David Letterman there. But here's a better picture of a gap. Okay, so this is a 5-minute chart. And you can see where we opened at 9:30 a.m. here at the very top. Actually, let me see if I can use this pointer here. Up here. And that was after we had closed right down here the next day. So the next morning in the overnight session, it may have been any type of a economic event, news release that happened pre-market. It could have been great news coming out of Japan, China, Germany, the UK, anywhere in the world that gave a little bit of boost to markets. It could have been earnings announcements. There's any number of reasons that markets will gap away or move away from their prior day's closing price. But it's that difference that causes these gaps. So this is an example one that opened up, and as many gaps do, retraced all the way back to the prior day's closing price fairly quickly. But that difference is what forms a gap. I am a gap fader, so I am fading the gap. That means instead of buying the open, I'm going counter to the direction of the opening gap. So in this scenario, I would short that gap, targeting the prior day's close or some point beyond, which is often is the case for me. Let me show you another example.